Hi everyone, today we're going to look at the stock of CVS Health Corporation, ticker CVS. So CVS was up about 20% last week off of the positive news on the COVID vaccine from Pfizer. And I think it's up because the market is kind of assuming that pharmacies like CVS will play a big role in the distribution of the vaccines when it comes out. In this video, I'll talk about some of the other reason why I think CVS is an attractive stock to look at, and as well as some risk factors. As usual, this is not investment advice, it's just all my opinion. So CVS was a $93 billion company as of last Friday, or $128 billion enterprise value. They generated revenues of $266 billion in the trailing 12 month. They got their start in 1963, known as CVS stands for Consumer Value Stores. They started selling kind of beauty and health products in the state of Massachusetts. Eventually, they expanded in the Northeast, and now all their stores sell, health products, but they're also pharmacies. In 2007, they acquired a PBM called Caremark RX, which they integrated into their business, and now it's called CVS Health. And in 2018, recently, they acquired the health insurance company Aetna. So naturally, the company breaks their business into the three segments through the acquisitions. So they have their original retail pharmacy, their clinic business, which is either the largest or the number 2 in the US. They're very close with Walgreens. They have 9,900 retail locations, 1,100 walk-in clinics. They have also their pharmacy business. They are the largest PBM in the US with a network of 68,000 retail pharmacies. And finally, through Aetna, they have the healthcare insurance business, and which is like the third largest in the US based on some Google search. They have 23 million members in the medical plans and about 13 million in the dental plans. So my first thesis about CVS is really their market position, and how through my research, I think CVS is the only publicly traded company compared to their competitors where they have all three. They have the PBM, they have the health insurance company, and the pharmacy under one umbrella, under one company. And I think because of that, you expect some kind of synergy from several areas. One is like if you're a patient of, let's say, Aetna, and you live near a CVS, then the pharmacy, the PBM, and the health insurer are basically they're the same company. And whereas like if there were separate companies, you expect there to be more friction and not as much efficiency because they're the same. You as a patient, you expect there to be some efficiency, right? Being these are like the same company. On the other side, like more of on the business side, because they're separate companies, you don't need you have cost synergies because you don't have as much redundancy in like corporate overhead. Like you don't need 3 CEOs or 3 CFOs. You don't need three separate corporate functions. Also, I bet all these 3 companies they use like probably the same type of IT systems or IT licenses. You can reduce a lot of the costs by you can reduce that by 2/3 by just because you're now the same company and you can share those across the organization, right? So also, you probably had dedicated teams at these if there were separate companies that just deal with, like you probably have a separate team at the pharmacy at CVS who dealt with Aetna. And now because they're merged, you can probably reduce some of the cost that comes from the redundancy of just of these companies being separate, right? So there's definitely, I think, cost synergies. There's probably more efficiency from the patient side. That's a competitive advantage for them compared to their competitors. The second thesis is more around it's more of a macro thesis around the nature of of healthcare in the U.S. So I read somewhere that like around 50% or more of Americans have some type of chronic health condition that's like heart disease, diabetes, or hypertension. And as such, they require prescription medication in order to either to maintain their quality of life, basically. And at the same time, U.S. is a country compared to the rest of the world with it's a country with privatized healthcare, right? So, which means that the healthcare is controlled by these companies whose main objective is profit seeking on behalf of their shareholders. So, and if you combine that with the fact that their customers are people who are people who basically need these products to maintain their quality of life or even to like survive, like insulin, and the fact that the pharmacies, the manufacturers, PBM are trying to maximize their profits, then you have a situation where basically these companies can charge whatever they want, and the patients need to pay for it, and they're willing to pay whatever they have because they need it to survive or to maintain quality of life, right? There's not really a good alternative. So that's why these companies tend to be like very cash generative, very good businesses, because they occupy a space where there's not a lot of alternatives, and the profits, they flow into the drug manufacturer all the way they trickle down to the pharmacies, to the PBMs, the insurance companies, so everybody, right? And you'll see later in the financial models that these companies they're basically really good businesses. The third thesis I already talked about is the upside from the Pfizer vaccine use, but that's already been priced in. That's why the stock's up 20%. So you can't expect like further appreciation from that because the market is already aware of that news. So let's look at the financial model. So as I said, CVS is a very cash generative company, and also it's trading at very reasonable multiples. It's just trading at about 10 times EV to free cash flow, and at 10 times it's almost like a value company kind of valuation. And it's not really unique to CVS. Even their peers like Walgreens trades at a very low 12 times. The insurance peers like Cigna and United Healthcare are also very reasonable, at 10 to 15 times, right? So I think the reason, I remember years ago, these companies were much more expensive, but then they went through the market went through kind of a Amazonification where everyone was afraid that Amazon basically announced they wanted to enter into the healthcare space and start like mailing drug prescription to people, and everyone was basically afraid of the disruption that could possibly occur, and these stocks sold off very heavily, and they never really recovered from that, even though it's been many years, and from what I see, no disruption has occurred in those industries, and these companies still make a lot of money. There has been no Amazon pharmacy or Walmart taking over the entire business, right? So I think it's a little bit overblown. Strangely, these companies never recovered their valuation even after that, and now they look like, given that the rest of the market is so expensive, they look like absolute steals compared to the rest of the market. Another way you can value this CVS that's kind of unique to these types of companies is using a sum of the parts valuation. You can do this for companies like GE or CVS because they have such like separate business lines that you can almost spin off as different companies. So with CVS, you have their PBM, their health insurance company, Health Insure, and their retail pharmacy. In their press release, they break down the EBIT, or the operating income, for each of these separate businesses, and all you have to do is apply a multiple, a market multiple, to get the market cap for the sum of the parts, right? And where did I get this multiple, I just took the average of their peers. So for example, for retail, the closest peer, the really only peer, is Walgreens. So I took Walgreens EBIT multiple, which is 11 times for that, right? So once you add up the sum of the parts, you take out the inter-segment eliminations, and I built in a very conservative synergy because of the thesis I talked about of just 250 million of cost savings a year. You come up with an enterprise value of $203 billion for CVS. So I realize you probably can't even see it. And today CVS has an enterprise value of 130 billion. So I think based on some of the parts, if you subscribe to it, it should be worth around 200 billion. So that's significant upside, right? Now it's a good time to talk about some of the risk factors that could cause a stock to like underperform. One is the integration risk with Aetna. Like Wall Street is full of stories where companies merged, and the mergers were not only did it not like provide any synergy, they ended up being very value destructive. Like one example is like Kodak, and like AT&T did a bunch of pretty bad mergers. But if Aetna doesn't work out, then instead of having like cost savings from synergy, you'd have a dis-synergy, which you have like a big negative number, and that could be value destructive to the company. And secondly, with healthcare companies and like insurance companies, you always have this big political, like public policy and regulation risk based on the political environment. And that's big because right now we just had, the Democrats just won the presidency, and it could be potentially a very different political environment where they'll make changes to healthcare regulation and, make changes to Medicare, Medicaid, Affordable Cares Act, and all those things. And the future is unpredictable. You don't know what's going to happen. But if it's like the status quo, then these companies are incredibly good businesses, very cash generative, very stable, and yeah. So that's my kind of analysis of CVS. Let me know what your thoughts are, and thanks for watching. And like always, I appreciate it if you subscribe.